one of the last Q&A lives as we start moving towards our show format. Good morning, everybody. Top of the morning. The sun has just come up. I just got done washing my face, so excuse me. All right. Good morning, good morning, good morning. We are live on all of the platforms. Okay. Let's see what we got here. So, changes in tax situations, changes in tax modeling. Reading over our update report and going out to our trust fund clients, whether they be generational wealth trust funds or whether they be business support trust funds, asset protection trust funds. Asset protection trust funds not really affected, but there has been a shift in the type of entity that the registered trust is recognized as. All right, here in Kenya, right? So the registered trust, what they did was they effectively repealed a tax exemption that is in the law for those trusts by removing the exempt status of the trust itself instead of actually removing the individual exemptions. So there was an exemption that anything educational was 100% tax exempt. And there was some other things in there as well. I think medical was part of it as well. And what was it? Something weirdly worded, like early adulthood housing or something like that, right? Something that was weirdly worded was completely tax exempt without a cap. And then your first 10 million of distributions per beneficiary per year was also tax exempt without a cap. So what they did was they took the actual trust and removed the trust's exemption. So those things are still there, but they're effectively repealed because the income coming into the trust is taxed at the corporate tax rate, right? So it's a little wonky. I'm sure people are going to be fighting to update it in the next finance bill or whatever, because a trust is still a non-trading entity, right? Which is a good thing for you protecting what's in the trust. It's not really something you want to change anyway. But it went hand in hand. The trust is a non-trade entity, so it's not doing business on its own, right? And because it's not doing business on its own, it has these tax exemptions, right? Because it can only make money through investments, you know, and that includes owning other businesses, right? But investments of some sorts. The only way it can make money because it's a non-trading entity. It itself cannot do business, right? So it made sense for it to then have these tax exemptions since it can only do business through other entities, and those other entities would have to pay taxes, right? So now that it's a taxable entity and it's paying the same, corporate tax rate as, those other entities might pay, it changes some things depending on how people are operating, right? So for our generational wealth folks, now it means that there has to be a focus on deductions, right? Because now that it's taxable, it it's also allowed to use deductions, right? It didn't need to use deductions before because it wasn't taxable. So deduct what, right? But now that it's taxable, deductions now matter, right? Let's see here. I know I had our legal team jump into the deductions that are going to be the most common ones. Let's see what we got here. All right, so the most common deductions now for the registered trusts of the trust clients are going to be trustee fees, right? Some of you guys didn't even have trustee fees depending on how your trust was set up and all of that. Now it makes sense for you to have them. It also makes sense for those fees to be a percentage of the income because you're going to be charged, right, a percentage of the income under the Income Tax Act, right? So you want to blast away a bunch of that with trustee fees. So if you're going to pay it anyway, you might as well pay it to the people who are looking after your trust, right? So trustee fees, And then our trustees are what's called ETIMS registered, right? If it's not an ETIMS invoice, then you're not going to be able to deduct it at all. That's also a new kind of rule, right? So what they did was they essentially rolled out their own like CRM software. So if you own anything like a pizza shop or whatever, when someone pays you for the pizza, the receipt, you run it through like a free government online system. So it's not like they're forcing people to pay, whatever and use their software. But they created a software. So now in the, our version of the IRS's system, they can match those receipts, right? So when you pay for the pizza, you actually give them the tax ID number. Like let's say it's a business pizza party, it's an employee pizza party or something. You would give them the business's tax ID number. They would issue the receipt. It would go right into ETIMS, and boom, it would be in the system. So if you logged into your tax account, you would actually see it there. Like on Wednesday, you paid whatever $10,000 worth of pizza. And so when you take your deduction, you would match it against the system, and boom, you would immediately get the deduction, right? So those asking for the deductions would no longer trigger an audit because there's somebody else, another business, that has already uploaded the deductible receipt, right? So that actually makes things quite a bit easier, right? So our trustees are obviously ETIMS compliant. And so when you pay the trustee fees, of course, the trustee is now looking at an income tax rate, right? But the trustee would issue out an ETIMS receipt, and then you would be able to deduct the trustee fees. A lot of the trusts have property, right? So like if you are one of the people who jumped into our end of year special, you got 1,700 square foot brand new property built, right? And you can have the trust manage, that property, right? Not directly. We typically do it indirectly, but still, it counts, right? So the property repair fees, same thing. So when you have somebody fix a pipe, fix a whatever, they got to be ETIMS compliant. So that now becomes your line of questioning for the vendors that you're dealing with. Are you registered on ETIMS, right? So all property repairs, no problem there. You're going to be able to go ahead and deduct that. Charitable gifts. Our version of like a 501c3 is called a KRA registered charity. So any registered charity, of course, you're going to get your deductions on that. And then your the bond amortization, if you have a bond that amortizes, then you'll be able to deduct that amortization as well, right? So you will be able to, to deduct that. Interest expenses, that's like if you take out loans. Not everybody's going to do that, right? But some people might look at it, but it's going to be few and far between, right? Not everybody's going to deal with that. So all right, there we go. So yeah, all right. Let's see. Investment allowances. Also, this is a big one. There is a investment allowance of 10% per year for commercial buildings. So for you guys who were investors and you guys were setting up like Airbnbs, and the Airbnb had its management company, and then the trust owned the management company, right? We have a ton of those, right? You get an automatic 10% deduction for investment allowances, right? So it reduces the taxable income generated by those assets by 10% right off the bat. So it's like a free 10%, for having commercial buildings. So if you're a Class G client, right? So you have an investor permit, you're running Airbnbs out here, or you're running hotels out here, or you're running a farm out here, whatever we set up under your Class G permit, then that property is commercial use, right? And so there's an automatic 10%, deduction that you'll get on that for anything coming out of that property, all right? Let's see. Any custody or brokerage fees, right? So if we do like special fund accounts, end up being qualified deductions. So what ends up happening is there's typically a DRIP, right? We've talked about this before. Your DRIP stands for Dividend Reinvestment Program. So you choose how much of your base, which are the bonds, get reinvested into the DRIP, right? So when you choose that, what'll end up happening is from that plan, you'll invest in a variety of things, whatever you want, right? Whatever you added in the trust deed, whatever you told the trustee you wanted, that's what they're going to invest in, right? Okay. So if there are any kind of brokerage fees on that investment, like if you get like Oak Special Fund, ArvoCap is special fund, Mansa X, special fund, things like that. There are fees, performance bonuses, brokerage fees, stuff like that that are part of that whole package. Those things are also, they're called custody and brokerage fees. They're also deductible. All right. So let's see. The management fees are also deductible, right? So you'll have your trustee fees you can come up with. You can also have additional management fees, which would typically be done by the trustee as well. But that would also reduce your taxable income. So essentially what you would do is you would set up your fee structure, particularly through your trustee, to take up the last 20% or as close to it as you're comfortable with of any income coming out of the bonds, right? Why only 20% when the corporate tax rate is 30%? Because if you remember, the bonds have a 10% withholding tax. Now, typically, the 10% withholding tax on an individual is a final tax, but on a company, it's a credit towards the 30%. So the bonds automatically withhold 10%. They give you a certificate at the end of the year. When you file your taxes, you say, hey, I already paid 10%. I only owe another 20%, but here are these deductions. Oh, look, the deductions equal 20%. I don't owe you anything, right? And so that's how that works. Same way virtually any other tax code would work. It's just that now your strategy has to be in place because it's not a tax exempt entity anymore, right? Any questions on that? If you're individually holding, it's still a final tax. So if you're individually holding the bond ladder, which some people do that, it's still a final tax. The only issue with that is, which if you're American specifically, then there might be, you might have to go through FTC to get rid of the tax burden on the American side, right? But if you're holding them personally in your own personal name, then the withholding tax is the final tax. So the 10% that they withdraw before they pay out to you, that's it. What about the 10 million a year in distribution? So it's interesting, right? Because technically it's now unlimited tax exempt distribution. Right? So the distribution to the beneficiary is now tax exempt, unlimited, right? But the reason it's tax exempt, unlimited is because you've already paid taxes on the corporate level. So it counts it as tax already paid when you do the distribution. Whereas before, the trust owed no taxes, period, and the beneficiary didn't owe taxes until you got to 10 million. Once you got to 10 million, then the beneficiary owed taxes, right? So everything above the 10 million, the beneficiary owed taxes on. Now, the trust is paying the taxes, right? And the beneficiary is never paying any taxes. So they flipped it. So it's very similar to the difference in the United States between a grantor trust and a non-grantor trust. It's like they've taken all of the trusts and turned them into grantor trusts, where they used to be treated as non-grantor trusts, right? So now It's the trust that's responsible for its local taxes, not the beneficiary after a distribution, right? Now, that's only on realized gains, right? So the bond ladders, they pay out every month. So you realize the gain every month. There's still 0% on unrealized gains. And because it's a perpetual trust, you could literally hold an unrealized gain for 1,000 years, right? So you could literally hold unrealized gains, have it in your trust deed that your trustee is supposed to check the law every year, and on a year where they slash the tax rate or something like that, realize all those gains at the lowest tax rate, and then turn that into the capital of the trust, right? Because after the taxes are paid, it's now capital, right? So capital, there's no taxes on, period. So whatever capital you started the trust with, there's no capital on. So any settled money into the trust, there's no capital, there's no taxes on, right? When you distribute it. And then when there's income made in the trust, it's at the corporate tax rate, right? But unrealized gains are still untaxed, and you can hold them forever because the trust lives forever, right? So there is that. Let's see. Can you get the exemption back? Well, you can apply for an exemption. Some of our clients are going to be given that option because they've had their trust long enough, and then it depends on the kind of work the trust does, right? So some of our folks are going to get that option. You have to be doing charitable work for at least 3 years. Now, typically, we don't recommend folks having trusts that qualify, though, because there's a non-discrimination clause in the charity work thing, right? So you don't want that, not because you got to remember this is Africa, right? So the countries aren't based on institutional racism, right? So when they use words, they don't mean the same thing that the words mean in America, right? So non-discrimination has nothing to do with black and white, right? Virtually everybody's black. So that's not what it's about. What it's about is that if you're giving away charity, you're not supposed to discriminate on who can get it, right? Which creates a bit of an issue for you if it's a generational wealth trust. Not everybody does a generational wealth trust. Some people actually do philanthropy trusts, and that's where this makes sense, right? So if it's a generational wealth trust and you try to tap into this, then the government argument becomes any citizen of Kenya should have access to the funds in the trust, right? So if you have a trust for you have a mention in your trust for like the arts, and you're like, oh yeah, no, people can apply to the trust even though they're not beneficiaries, and we'll look at the application, and then we'll choose like who gets some money to go to art school. How do you make that choice, right? It has to be non-discriminatory. Anybody in Kenya should be able to get that money then, if you're getting the tax exemption. So it's almost like the 501c3 thing, right? Their version of it. If you do that, everyone has to have equal access unless it's a highly marginalized like community. So if you say, okay, everybody with a physical disability, that's okay, right? Because it's a highly marginalized community, it's okay, right? It's almost like the protected class thing. Like you can't discriminate against protected classes, but if it's not a protected class, you can discriminate, same type of thing. If they're super marginalized, then you can go ahead and focus on them. But everyone in that marginalized group has to have access, right? Not the type of thing you want for dynasty and generational wealth, right? So for those people who do philanthropy trusts, which we do have quite a few of those, believe it or not, those people can now tap in and essentially become a 501c3, right? And then the tax thing is going again, right? Outside of that, then what folks might be looking at doing is actually setting an endowment or a charity beneath the trust, right? A registered charity or an endowment that acts as such. And that way, part of the deductions is the whatever they give the charity. So, for example, in the United States, if you have a private foundation, you have to donate 5% of your AGI per year to a 501c3 public charity, right? So you essentially create grants and let the 501c3s come and get the grants from you, right? It has to be 5% of your AGI your adjusted gross income for each year in order to keep that foundation status, right? And so something like that you would be able to duplicate. So you can say, okay, I'm going to create this charity. It's going to do whatever charitable works it's going to do. There's no discrimination. Everybody can come get that money. You know, they fill out the application, and an independent board makes a decision. Blah 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 blah. We give them 10% of our income, you know, each year, and that's it. Because you got to pay it anyway. You're going to either pay it the taxes, or you can build some schools, get some girls some tampons, or whatever it is you want to do. Right? You can do some charity work wherever and pay that money out that way because you're going to pay it anyway. This is actually how taxes are supposed to work, right? It's supposed to be, okay, look, you can pay into the government, or you can actually do something for your community and help your community, and then you don't have to pay us. Because if you paid us, we should be doing something for your community with that money, right? So it's either or. If everybody in the country has a thing going on, or has at least a local community thing happening that their money is being poured into, and they're diverting their tax funds and putting it into this thing, and it's building their roads, it's building their schools, it's taking care of X, Y, and Z, then there's no need to pay the government, because that's what the government is supposed to be taking care of, right? So that's the way it's supposed to work, you know, essentially everywhere. It still, you know, works that way here to a certain extent. This is very much how it worked, like in the like the Roosevelt era. You know what I mean? Where the corporate tax rate in the United States was 95%. How do you not pay 95% in taxes? You do stuff for your community. You get tax write-offs. You know, you donate to, you know, children's homes. You know what I mean? You fix the roads. You whatever. So in America during that time, that extreme corporate tax rate was used to make sure that corporations were good corporate citizens, right? And so that's exactly what's going on here. So while when we typically hear taxes, it's actually a solid situation where, in order to eliminate those taxes, you simply give back, right? You just simply write that into, you know, what you're doing. All right, we're going to give back at this rate per year. That's going to, you know, remove our taxable liability. And so the only tax, and this is only for the bond people, the only tax that they're getting is the withholding, right? Now, on shares are now better than bonds from a tax perspective, not from an ROI perspective, okay? From a tax perspective, shares have become better than bonds now, because if you own shares and those shares shoot you a distribution, number one, distributions come after corporate taxes. So the company that you own the shares in have already paid its corporate tax. Okay, so that's number one. When they shoot you the distribution, they have to hold a 5% withholding tax on that distribution. That is a final tax, right? So when you're getting income into the trust from a share distribution, you pay 5% final tax. It's done. When you get it from a bond, the bond has a 10% withholding tax, and that's a credit towards your 30% corporate income tax. So there's another 20% that's owed, right? That you can deduct and get rid of, but there's another 20% that's sitting around. All right. Now, the Holy Grail is still the infrastructure bond. All right. Holy Grail is still the infrastructure bond. Infrastructure bonds are still 100% tax exempt, withholding tax, income tax, all of that tax, none of that tax. It doesn't matter. If it's an infrastructure bond, you don't pay nothing, right? And again, it goes back to my last statement. Infrastructure bonds are exactly what they say they are. You're building the infrastructure of the country, right? And so that's why that tax relief is there. So I can guarantee you some of our more savvy clients are going to be calling the trust company in the morning here and telling them to go to the secondary market and get every infrastructure bond they can get their hand on and turn their entire portfolio into infrastructure bonds. Right? So those bonds that have already closed and they're already gone, you can buy them on the secondary market if they're available, right? Somebody has to be willing to sell the ones that they have, right? So that's the thing with bonds, is they're not liquid. The bonds sit until maturity. So when you want liquidity, you go to the secondary market. When you go to the secondary market, you typically lose, right? But you lose for liquidity now. And of course, it's essentially tax-free liquidity because the money you put in, the taxes were already paid on. So if something happens, you're trying to, pay a medical bill or something, whatever, they go to the secondary market. So you're going to see savvy folks hitting that secondary market, snatching up all the infrastructure bonds, and going from there. So now we'll see. Now we'll see, with the new tax rules, whether they hurt themselves in their own bond sales. Because they probably should have put a contingency in so that the government can still raise money. But we'll see what happens. Yes, you can. Yes, that's a great question. So when you're an individual and you have the withholding tax, it is a final tax, right? So technically, you don't even have to file your taxes after you get hit with that withholding tax. It's a final tax. You're done. They prefer you file anyway, but you just won't have to pay any taxes, right? But it's a final tax. Now, if it's the trust that owns the bond, they just made it so that it's not a final tax anymore, right? The withholding tax is still there, but it's not a final tax anymore. So your question is absolutely valid. Now you can actually deduct the entire 30, which means you can force them to give you a tax return on that 10% that they withheld, which I'm sure is going to pop up all over the place here. And they might have to rethink this because all of those folks that are savvy enough to have trusts are also savvy enough to have tax people who are savvy enough to get that KRA to now start kicking out tax returns on that 10% that they used to be able to keep. So, very good question. How's it going, Chief? Ooh, that doesn't look good. Can you give me that box? Is it okay? Oh yeah, I guess it's all right. Yeah, it's fine. Sorry about that. Let me sign for this package and then I'm right back with you guys. Great question, though. Great question. I woke up early today, Chief. When did you get up? How long have you been awake?
Yeah, town.
From Mombasa.
Yeah, Mombasa.
All right. 1 second for me to sign for this, and I'm back with you guys. What did I get? probably fountain pens. If you know anything, it's part of our tradition as a family, um, is leaving journals for the next generation. And then because we do that, handwriting is one of our focuses as a family, right? So our kids learn extraordinary handwriting, and thank you. And we have libraries, and in those libraries, you can go and look up different volumes of people from your family who were there before you. So you can essentially ask your elders questions after they die, right? You can go to their section in the family library and literally pick a day, any day you want out of their life, and read what happened. And the journals are coded. So there are some journals that are just like almost like a diary. There are some journals that are coded as like business wisdom. There are some journals that are coded as social wisdom, right? So we can actually leave an entire compendium within our family trust and within our family constitution to the next generation. So, like for example, my father and my mother are both dead, right? So now there are things that I see with there are things that I see with like my son, and I wonder to myself, like, oh, did I used to do that when I was a kid? I don't have anybody to ask, right? And there are no journals sitting around that I can go into the journal, and look at dates when I was a kid, and and see in there like, oh yeah, little John did this today, did that today, da, 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 right? So that was something that we fixed from a family constitution standpoint. Yeah, now we do all kinds of like fun stuff with it. Like there are general journals and specific journals, right? So there are general journals that have like family recipes in them, and we're good. Okay. Hold on a second. Let me throw you a tip. And so those journals end up having like fun stuff. Like we have ink that looks like olive oil. So when we do like a recipe, the ink looks like olive oil. We have ink that looks like chocolate or ink that looks like strawberry jam. We write like recipes. It's written in like funky ink and all that stuff. Everything's handwritten. Thank you.
Thank you.
And Swalehe.
Yeah.
So thanks for coming out.
Thank you.
And so what did I just do? I just pay. Oh, yeah. So there's a digital, there's a digital currency platform here, so you can pay everybody with your phone. It's awesome. Everybody, and you don't need a smartphone. Like you can have what do they call it in the U.S. An Obama phone, and you can press like pound 123 star, or star 123 pound, and like it'll bring up a menu, and you can send money, receive money. It's beautiful. But yeah, so handwriting is one of our kind of family pillars, and because of that, there are pens everywhere and ink everywhere, and people working on their handwriting and all of that stuff. So if you go to my personal TikTok, I don't really do a whole bunch of uploading anywhere else. But if you go to my personal TikTok, and I'll put my personal TikTok up here in the corner on the TikTok pages for you guys. There you go. So that's my personal account. And there's a lot of handwriting stuff there. Sometimes there's business stuff if you're into that, but a lot of handwriting stuff. And a lot of family constitution style stuff, and how to maintain a generational wealth family and things of that nature. So yeah, so that's what that is. Yes, it's Amazon. Yeah. There's no Amazon here per se, but Amazon has global shipping. It's not cheap. What they do is there's something called direct duty paid shipping. That's what Amazon does. So they charge you the price of the item, the shipping charges, the taxes, and the duty, like the import fees, all up front. So if you buy $500 worth of stuff on Amazon and you ship it internationally, you're looking at probably paying about $1,000. Now, one of the good things about Amazon versus just importing it and paying your taxes like at the docks, is with like in about 3 weeks after you receive your stuff, you will get a refund. Because they always make sure that they don't have to ask you for more money. We do the same thing, right? So you pay a premium fee. It's just so that they can handle everything, and then when they're done, they give you whatever's left back. So I always I just got like a $200 refund or something like that from Amazon like a couple days ago. So just they just throw it back in your account. They don't put it. That's the other thing. They don't put it as like a credit on Amazon where you got to buy something else. They just give you your money back. So that's cool, and you never have to go deal with KRA, who we're talking about right now, taxes. You never have to go deal with them. You never have to go show them your tax ID number or anything like that. They just do it all for you. Very, very, very cool. So premium service up front, but works out in the end. All right. So yes, you can get them to now give you a tax refund because they really didn't think about this. Like they did it, but you can tell it was like knee jerk or something because they actually opened themselves up. And maybe they're looking at it as a good thing. Like maybe they're like, all right, well, you can get your money back. You know what I mean? Like, I don't know. But they definitely opened themselves up to some weirdness by doing it the way they did it. All right. Does the strategy remain the same? Yeah. So the strategy typically remains the same. We can do some focusing on special funds because special funds are going to have deductions built into them, right? So there's definitely going to be a focus on special funds, but there already was. The bonds were the base, and then the special funds came later. Now, high dividend shares might be a shift. It's riskier, excuse me, because it's still corporate shares and the corporation can go out of business and the blah 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 blah. So it's riskier, right? But high dividend shares are probably going to move into the realm of the creme de la creme because the high dividend shares are going to have the final withholding tax, the dividend final withholding tax of 5%. They're not going to have the 10, and it's possible to get a 15% withholding tax on bonds as well. So, but typically it's 10. We haven't seen a 15 in years. So, you're looking at the 10% withholding tax, but it's a credit, right? So, like we just went over that. For the on the corporate side, it's still going to be 30%. So that 10% withholding tax is a credit towards the 30%, right? And so the issue then becomes the 5% withholding tax on shares is final. It's not a credit. So you could just pay 5%, withholding on the shares and then call it a day. Because what ends up happening is it's a share of a company, right? So what did the company pay? The company paid the 30%, right? So that's why there's a 5% withholding tax to you because they already got their 30% of that money. So they actually get an additional 5%, and then you don't have to pay anything else. So that final tax may become an early type of strategy for some folks, but there has to be high dividend, premium, valuable shares that you trust, right? So primarily, the majority of those high value or high dividend shares are going to come from things that you own, right? So like we got a lot of folks that own Airbnbs, right? A lot of folks that own agriculture business, farms and stuff like that, and then the trust owns that business. So that's where the high dividend is going to come from, right? Like you're going to make whatever profit after taxes, right? You're probably going to have your own deductions and deduct whatever you need to deduct to get your own 30% down on that corporation, right? And then after you're done with that, you'll kick up to the trust whatever you want to kick up to the trust as much as you can, right? And pay the 5% instead of the 30, and that would be a final withholding tax because it's a high dividend share. It's a share. Period. Doesn't matter whether it's high or low dividend. It's a share. So you're just paying the 5% withholding, right? So that's typically where most of that's going to come from, right? So in your infrastructure and in your ecosystem, did you still pay the 30%? Kind of. You probably paid it out to, managers and stuff like that and got it as low as it possibly could be, right? So most of that money helped the community and went from there. And then what was left, you paid another 5% on and threw it into the trust, and then the trust holds it tax exempt, right? And then because it's considered tax paid in the trust, when you distribute it, it's also tax exempt. So now essentially all distributions are tax exempt because the taxing happens at the trust level now. So taxes at the distribution level are null and void now from Kenya on the Kenyan side of things, right? If you're an American, you got an American tax return. Beautiful thing is that the FTC typically applies, right? So the FTC is going to let you deduct dollar for dollar every tax that you paid on this side against what's going on the American side. So that's helpful. Yeah, somebody had asked that earlier. If you hold the bonds in your own name, then the withholding tax is a final tax. So then it's the 10%, but there's no way to get rid of it. There's no way to get a refund. There's no way to get a deduction. Like, it's done. They took their 10% and it's over. No, not necessarily. So a lot of people kind of expose themselves with questions like that, right? If you have a trust and you can afford to have a trust, what would make you think you can't afford a CPA? So if you have the trust, why would you actually be paying the 30%? Your CPA should handle that. Your CPA should show you where to put that money so that you can deduct it, right? So it kind of, it exposes a mindset that needs to be worked on, right? If you have the wherewithal and the savviness to set up a generational wealth trust, then you have the wherewithal and the savviness to have the tax person telling you what to do to make sure you're paying the least amount of taxes or even no taxes, right? So that's kind of like a non-starter question. Well, yeah, it's like buying a Bentley and then complaining about gas prices. If gas prices affected you, you would have a Pinto or a Camry. You wouldn't have a Bentley. You wouldn't have a $250,000 car and then talk about gas prices are high, right? You'd have a $20,000 car, So it's one of those things. Like, you can't have a yacht and then complain that gas prices are high. That's an American thing. 1031 exchange is an American thing. However, there is something kind of like it, right? So shows that you have been around for a little bit if you know what a 1031 exchange is. You can do that here as well. You can do it like with real estate. And what it is it's an unrealized capital gain here, right? And so, but you can unrealize that forever, right? So you can unrealize that for a very long time, and then you can have instructions in the trust that anytime something happens with they do a different finance bill every year, so they can effectively change the tax rules every year, and so you can have your guys looking out. You can even instruct after X amount of years to start lobbying for a specific type of change, right? But you can have your guys looking out every year, and then whenever the tax laws change and are favorable, you realize that gain at a lower tax rate, right? And make sure that you don't realize that gain higher tax rate if at all possible. So yeah, you can do that. Yeah, yeah, definitely. Yeah. Well, your guy's gonna do it. You know what I mean? It's not like you're sitting around trying to figure all this out yourself. That's what you get professionals for. There are people who do that. They're just gonna go to jail. They're never gonna be able. Like if they could, they would be an accountant and they'd be making $100,000 a year as an accountant, right? Like, Chat GPT and YouTube got people's heads swollen. You can't be a McDonald's manager talking about you can do international taxes on your own if you just ask Chat GPT. If that's the case, ask Chat GPT and open up a brokerage and make $100,000 a year and quit McDonald's. Like, what are you talking about, right? So it's your professional that's going to handle all of that. You're not going to do any of that yourself. Right? Yeah, it's crazy. It's crazy. The stuff we see, we've actually had people that like argued with us. We turned down their business. We were like, listen, we can't set you up for failure. Have fun, da 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 da. We get a phone call 6 months later from jail. Don't you guys a law firm. I was arrested for embezzlement. Can you guys get me out? Mm-mm. Ain't got nothing to do with us. You gotta call a. We don't have criminal defense attorneys. That's not what we do. You gotta have to call somebody else. But there are hard-headed people out there, and as my grandmama used to say, a hard head make a soft ass. So, some people got to learn the hard way. It is what it is. God bless them. Yes, there is a way. There is a way. Infrastructure bonds only, and there are going to be certain clients that do that. Yeah, yeah, yeah. So there is a way to kind of go back to the old regime and kind of have the old treatment. You're still not exempt anymore, but the bond is exempt. So if you do an IFB, it's still a 100% safe haven. There's zero tax on the interest. There's zero tax on the entire thing, period. And then there's zero tax on the distribution. So, so yeah, if you're infrastructure bond heavy, then you're good to go. But in order to do that at this point, you'd have to go to the secondary market, and they'd have to be available. Of course, your trustee can facilitate that for you. So the trustee can take you to the secondary market and make sure that all of that works out. But yeah. Yeah, I mean, probably what most of our clients are going to do is they're going to split it up. Most of our clients like to give back anyway, right? We're pretty choosy about who we work with to begin with, and so the type of people that we typically work with want to give back to the community anyway, right? And so what they're probably going to do is they're going to say, okay, I got a 10% withholding tax, but I've always had a 10% withholding tax, even when it was tax exempt. Withholding taxes happen at the central bank level, so it happens before it even touches you. So all right, fine. So I've always had to pay that 10%. All right, cool. Now there's another 20% here that is levied against the coupon payments from the bond payments, right? And so now how do I get rid of this 20%? Right? So a portion of that is going to be the easy way, trustee fees, right? So we'll just change the way the trustees charge and all of that stuff. And like, so your trustee fees, let's say it gets rid of 10%. Cool. Now we've deducted that 10%. That's not going to taxes. All right, what are we doing with the other 10%? Probably charity, right? Probably we're building schools, we're drilling boreholes and giving, local people water. We're doing all kinds of whatever, right? But it has to be essentially a donation to a registered charity to keep your trust insulated. You don't want to start doing charity work directly from the trust because then you run into a headache with the non-discrimination laws, right? And then it opens kind of a door for any Kenyan to make a claim that, oh, that's a charity, so it's supposed to be open to all Kenyans, and therefore I want a piece of what's left there for their children because they've turned their trust into a charity. You don't want to do that, right? So you'll just make a donation to the charity that's doing the work that you want to see done, or you'll register it your damn self, right? Right? If nobody's doing the work you want to see done, you register another charity and you pump that money into your own charity and go from there, right? So that's more than likely how to be done. It'll probably be done in those tranches because it just makes it easy. So 10% to the trustee and the management fees, another 10% to the charity, or 5% to the charity and 5% to maintenance or whatever if you have a building, and then that'll be the end of it. So yeah. Yeah, I mean, looking at it through I suppose, the best lens, they're forcing you to give back to the community, which is great because there's a lot of Europeans out here that live great and do nothing. You know what I mean? They'll come here with their euro and build a great big house and isolate themselves from the local population and not let locals on their property and all kind of neo-colonial BS, right? And then from there, they don't offer anything. And then what'll end up happening, we talked about this a little bit, last time, is they may even have children and all of that here, and then when they die, all of a sudden their European kids show up and take everything, right? So like, because they never, I don't know what it is, like some kind of weird cultural faux power. I don't know what the hell it is, but they never marry locals. So it's almost like they just use them until they die, and then whatever, right? So it becomes a bit of an issue. So the law is now almost forcing people to go ahead and invest locally, which is definitely a plus. So even if they do their bullshit, you know, where they're not really engaging with locals the way they should be, and they use them for 40 years and then throw them to the side, well, they're still, they would have to have a bunch of projects that they poured money into, or they just give all that money to the government and the government handle it. You know what I mean? So it does make sense when it's managed properly. Hey, Milka. Good morning. Yeah, well, so that's why you have deductions. If you think that the government's corrupt and they're not going to manage the money right, then get rid of the taxes with your deductions and wipe the taxes out. Then you don't have to pay the taxes. You ain't got to worry about the government being corrupt. One or the other. That's not really an excuse, because built into the system is the ability to not pay them the taxes. So then don't pay it to them. Correct. The tax rate is 30%. Yes. And then you have deductions, and you can deduct 100% of the tax rate. So either, you just want to be negative your entire life and look for problems for every solution, or if that's the way you believe, deduct and not pay the taxes. Problem solved. What's your next excuse? Some of y'all, it's mindset. Some of y'all don't need no services yet. What you need to do is improve your mindset. Yeah, yeah. So, I mean, you can have as many as you want. It's still a non-trading entity, so you can't do business. Not, and you shouldn't want to. Even if you could, you shouldn't want to, because what you don't want to do is create liability for your heirs, right? So you don't like want to own stupid stuff with the trust, which you actually could do that, but you don't want to run a business directly from the trust and then have employee lawsuits or vendor complaints or any of that bullshit, right? You don't want that touching the money that's left for your heirs, right? And you don't want the trust to own stupid stuff, litigious stuff like cars. I hear that garbage all the time on TikTok. I put my cars in my house in my truck. They don't know what they're talking about, because if you get in a car accident, who owns the car? The trust. So who gets sued in that car accident? The trust. So now you just gave someone access to all of the money that you're compounding, for the next generation, because you were dumb enough to put a car in a trust. Are you, like, what? So there's certain things that you just don't put in there. It doesn't make sense, right? And so all of the business stuff you want to do, you want to open a business underneath, the trust that's owned by the trust, where the trust owns the shares, but the trust should not be acting as the what they call a managing director here, or a director, period, right? Which would be like CEO, CFO, whatever. They can just call it all director here, right? And so you want to be a shareholder, but you do not want to be a director. Here, it's not like like when you hear director in the U.S., it's like the board, which is like where you should be. Here, a director is like a direct employee of the company. So you don't want to be a director at all. You just want to be shareholder as the trust, and then you want a person to be the director. So it's like having a CEO out in front who handles everything, and then they pay you your dividend, every quarter and the year, every month, however you want to set it up, because you did set up the company, right? And you're essentially the chairman of the board, so you could order them to pay you however you want them to pay you. But that's what you want. You don't want to try and, first of all, if you do try and operate the trust as a business, that's a violation of the Trust Act anyway. But you don't want litigious stuff owned by the trust. It just doesn't make sense. You hear that all the yeah. I mean, tell them to give you an indemnification. You got some idiot telling you to put your car in the trust. Say, okay, indemnify me. If I get in a car accident, you pay it. And see how quickly they stop telling you to put your car in the trust. If we tell you to do something and you feel like it's funky, we'll indemnify you. We will sign an indemnification and we will take on the legal liability of that if we have told you that this is the way to do it. Plain and simple, right? So you got a lot of these, kind of idiot influencers telling you all what to do, but then when you hold the accountability to them, say, okay, really, I should be doing that? Cool. Sign this indemnification. If it goes wrong, you pay it. All of a sudden, it's up, and backpedaling, right? Real easy way to see who's who. Yeah, tons of foolishness. I guess it's Chat GPT or something. People thinking that, it doesn't hallucinate and giving all the wrong advice without any expertise or whatever. I don't know where it all comes from, but there's so much garbage out there. Just be, if I just real easy, like just make people put their money where their mouth is. Okay, give me a guarantee on that in writing. You know what I mean? Like just start holding people to that, and you'll see how quickly people run away from you. An example of the math. An example of the math on which one? I'll give you an example of the math if you want. That's fine. But just which example do you want? How to get rid of the 30%? Okay. All right. So let's say the trust earns $1 million. All right, so the trust earns 1 million Kenyan shillings, like less than $10,000, right? So it's actually reasonable. I know the word 1 million makes you what, but it's actually reasonable. The trust earns 1 million over the course of the year. So if it earned 1 million and there's a withholding, then there's 30% in your corporate tax rate. If your management and your legal fees, so your trustee fees and your legal fees are 200,000, right? So 20%. Then, this would be 20% of the 300,000 that you owe. Then you would only owe that last 100,000, which has already been withheld by the withholding tax, if all of that came from bonds, right? Some stuff doesn't have a withholding tax. So we're assuming everything from bonds. 1 million in bond coupon payments. You paid 200,000 in management and legal fees, right? So that 200,000 goes to management legal instead of going to the government. So you deduct it against the government, and now you end up sitting on the 800,000. That's left over versus if you didn't pay anybody, like if you soloed out your trust and you didn't pay anybody, then you would still pay the 200,000 plus the 100,000 in withholding directly to the government, right? And then you would only be looking at 700,000, right? So you would make less because the payment to legal and management is also deductible, right? So you pay it out and then it's also deductible. But what it does is it lowers the amount of income that came in. So now the withholding tax is wrong because your taxable income isn't 1 million anymore. Your taxable income is 800,000. And that first 100,000, 10% on the withholding tax was based off of the million. So their withholding tax is actually wrong. So now it's the 800,000 that you're working off of, which means that they should have kept 80, not 100. So they already owe you 20,000. Is it cutting through now? So you reduced your taxable income by paying the trustee and all of that stuff, and that makes their withholding tax an incorrect amount. So you're going to get a tax refund right off the bat. So you're essentially using pre-tax income to pay for your expertise in management to grow your fund. So when it all comes out in the wash, their original numbers are going to be wrong. But there'll be an ETIMS receipt to back that up. So they're not even it's not even going to trigger an audit, because there'll be the ETIMS from the trustee and the management and all of that. There'll be an ETIMS receipt from them that you paid them. And so it'll automatically balance within the KRA system, and they will automatically give you that refund. As long as you file for it. Obviously, if you don't file for it, they keep the money, just like the US, right? Or if you don't do your tax return and you're actually owed a refund, they just keep it, right? So as long as you file for it, you'll get it back. But you'll get it back immediately because of ETIMS. So as long as ETIMS works the way it's supposed to work, there's no questioning your filings anymore, because there's another organization that's paying tax on that income because you paid them, right? So they're paying tax on that income. So people ain't giving no fake ETIMS receipts, because now you owe 30% on that ETIMS receipt, right? So the ETIMS receipts are definitely assumed to be legitimate, because the ETIMS receipt also proves that that other company owes taxes, because that other company made income, right? But for your purposes, from the direction of your trust, it would then lower the income to 800,000 instead of $1 million, and so there would automatically be a refund that would probably be due on the withholding tax, because they withheld too much. Just yeah. So if the trust earns $1 million in bond or in interest, right, but pays 200,000 in management fees and legal fees and all of that, then it only pays tax on the 800,000. But because they're bonds, the bonds have already taken the 10% based on the million. You see the issue? So now you tax me based on $1 million up front, but because of my deductions, I only have 800,000 in taxable income. So that 10% of the billion that's the wrong number. It should be 10% of 800,000. Because it's a withholding tax, though, they withheld it before you made your qualified deductions. So now they have a problem. Now their math is wrong. But in the system, because of ETIMS, they immediately can confirm what you're saying is true, because you have an ETIMS receipt. That's why the only deductions that they will accept are ETIMS deductions, which is why the only people you should be doing business with in any way, shape, or form here are legitimate people who are issuing ETIMS receipts. There is a way to do that. There is a way to manually enter ETIMS. Let your CPA handle that. But yes, there is a way to do that, and essentially, it'll jam up the other person, because when you enter that in manually, the government's going to go to that other person, and why are you doing business without registering for ETIMS? It's kind of like sending a 1099 in the U.S. to someone who, didn't plan on paying their taxes that year, right? So when you do business-to-business transactions in the U.S. over $500, you send a 1099 if you haven't withheld, and then their tax payment is on them. So some people who don't manage their taxes properly get a 20 1099s at the end of the year, and they owe, 30 40,000 dollars that they didn't save all year, and now they have a problem. So this essentially the same thing would happen if you have to manually input an ETIMS for something that you did, and that person wasn't ETIMS compliant, then they're going to have an issue. You're going to immediately be flagged, immediately be audited, because you're probably not the only one, right? Like you're probably not the only one who did business with them. So, got to be registered. Sure, 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 sure. Yeah, it's just part of the ecosystem, isn't it? Yeah. All right. Any other questions on that? Any other questions on how that works? Ha 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 ha. All right. Words do not mean the same thing in every country, right? The question is for those of you guys on the other live streams, if it's bond income, wouldn't it be capital gains? Why are you paying income tax? Because in this country, capital gains only applies when you sell an asset. So you could do capital gains if you sold the entire bond on the secondary market. Then you can do a capital gains. If there was one, you probably would lose if you sold the bond before maturity on the secondary market. But if you somehow won, then you're talking capital gains. All right, which yes is a lower rate, but your passive income, your ongoing passive income, is not considered capital gains in this country. Capital gains in this country is a one-time payment. Which is the argument in the United States, right? That rich people pay less taxes than poor people because they use capital gains. Can't do that here. So the argument here, because everybody has, a complaint, right? Everybody has an excuse. Everybody has a complaint. Everybody got something to say. So the argument here is that the middle class are paying all the taxes and that the upper class are paying all the taxes because you can't do the capital gain thing. So they do, the more you make, the more taxes you do pay, right? And so it works the way it's supposed to work. In America, we're all, well, I don't know about all of us, but in America, the mantra is let them pay their fair share. Here they are paying their fair share, right? So, but people still find something to complain about. It is what it is. Yeah. On the sale, capital gains on the sale. So yes, if you have a capital gain strategy, then you want to work the rollover. Because remember we said you could roll over something and have an unrealized gain, which is tax exempt, but you really have to unrealize it, right? So you can have an unrealized gain, and because the trust is perpetual, you could hold the unrealized gain for 1,000 years. If you don't need the money, you can roll it over and roll it over until there's some event that happens, where the tax, code changes, or they grant tax amnesty for a year or something like that, something that you can take advantage of, and then you execute that unrealized gain. So yes, you could do that. Well, yeah, it depends. It definitely depends on which type of trust it is. Because if it's a generational wealth trust, you ain't supposed to be dipping into the money anyway. It's supposed to be compounded for the next generation. So it doesn't matter at all if it's a generational wealth trust, right? Now, if you're dipping into the money and it's some other kind of trust, then you need your strategy in place. We don't do asset protection in this country. So if it's asset protection, you don't have to worry about that. We do the trust in a different country. It depends on the asset, and it depends on where you do business. So it depends on what the asset is that you're putting in the trust now, and it depends on what your asset generation machine is, which that's a business, not a trust. It depends on what that is and where you do business the most. because that's the type of stuff that you're going to be putting into the trust, as time goes on. So those things will determine which country is the best country for you. The asset class, where you do business, your tax nexus, all of those things have to be considered. Anybody who would answer that on a live who knows nothing about you is full of shit. I try to put it where the goats can get it. You know what I mean? I can speak, the Queen's English and be as highfalutin as you want me to be, but I try to put it where everybody can get it. Yeah. Yeah, no, it's really not. It's really not that big of an issue. You just have to, figure out what kind of charity you want to commit to and all that. And like not be wrong if the charity goes awry. You know what I mean? Like it is what it is. And if you're going to be like that, then let us know. We'll form a charity for you. Like we'll let you know what that costs and we'll get that set up and then we'll do whatever it is you want done. Great question. Great question. We don't know. That's the freaking answer. We don't know. So one of the trust companies does a program where the kid, like they'll take boarding school kids, and the trust will manage everything for the boarding school kids. So they'll pay the school fees, they'll pay the living expenses, they'll pay for the food, any kind of medical expenses, all of that. Well, medical, education, and early adulthood housing used to be tax exempt. But now the trust itself isn't tax exempt. So now it becomes an issue. So yeah, our legal team is on it, but we don't know yet. So there'll be a show, I'm sure. I probably won't be one of these live Q&A things because since we're switching to the show format, but there'll be a show that addresses that very soon, I'm sure. All right. Any other questions on any of that? No other questions? We're good? Everybody gets it? We know what we're doing with our trust funds? Outstanding. Outstanding. All right, I think we're done then. If you're sending me something, just go ahead and press enter, and I'll wait for you to go ahead and finish up whatever it is you're trying to type, or throw a one in the chat, and I'll wait for you to ask your question. Other than that, I will call it a day and figure out what I'm having for breakfast. Yeah. Generational wealth is super important. Does it affect? No. We're still doing 100 generational wealth trust funds by the end of the year. We're up to 12, so we're still counting it down. We want that impact in the community. Nah, you can only lead a horse to water. You can't make them drink, right? So there are some people that are going to have an excuse for every solution, and we don't even work with those people. Like if we're in consultation with them and all they got is excuses, like asking questions are valid, but if all they got is excuses, they can go back to TikTok with that. We don't have time for that. We need people who want to change their destiny, people who want to actually get it done, who want more action than talking. Those are our people. Yeah, absolutely. Yeah, no, it, there are so many people who are all talk and no action, and it'll drain your resources. Like you can't allow those people to infect your staff, number one, because if there's people complaining about you around you all the time, that is a toxic infection that spreads like a cancer. And then once we like started not doing business with people who weren't our target clients, even our retention rates, you know what I mean? Like, employees stopped quitting because of all of the, idiots who were causing them stress. So once we like cut those people off and just like stop doing business with them, our employee retention rates exploded. Like barely anyone ever leaves us now. And our outcomes for our clients that had the right mindset tripled and quadrupled, right? Because everybody was motivated, everybody was positive. Every time you answered the phone, there was a positive person on the other end. So that has a compounding effect in and of itself. All right. Any other questions or comments? All right, looks like we're done. Looks like there are no more questions, no more comments. So I will call it, guys. Thanks for hanging out with me. I will be here tomorrow, but by the end of this week, we will have shifted to the show format. So I won't be doing these lives anymore. They'll just be shows coming out. Hey, how's it going, Momo? It's excellent today. Excellent, excellent. I think it's about 80 degrees so far at the time of day here. So not bad. Got the ocean breeze pushing the palm leaves in the back there. Yeah, not bad at all. All right. Nothing else from you guys? Oh, great to see you too. See you later. All right, that'll call it then. All right, guys, thanks for hanging out with me. I will see you guys tomorrow, same time, same place, yes. But by the end of the week, we'll be done with these lives and we'll be shifted to our programming. All right, talk to you guys later. See you.